All right, everybody, welcome to eCar's Affordable Housing Workshop and meeting today. I would like to introduce our main speaker, who's going to be giving us a lot of good information today, Jim Hall from Freddie Mac, and he's from the single family home division. And Jim, can you introduce your team? And I'd love to hear what we're going to be covering today. And before we do that, I forgot to mention a couple housekeeping things. We're going to have everybody on mute during this call, and we are going to be recording the call. So if you want to be conscious of that, be sure to use chat. Both Susie and I are going to be monitoring chat, and at the end, we're hoping to have some Q&A because today's webinar is going to be hopefully at 1 hour mark, and we'll save a little bit of time at the end to go through any questions that you have. So Jim, take it.
All right, Greg, Susie, thank you very much for having us today. We're really excited about sharing some valuable, affordable product solutions information with your members. With me today are two of our great partners, and we have Rita Bellinger from the Connecticut Housing Finance Authority, and Pam Days-Luketich and Ann Marino from our lending partner, Liberty Bank. And so today's going to be very informative. You will get a copy of the presentations, so you don't have to think you have to jot all this information down, because there's going to be a lot that we're going to share with you. So Susie and Greg will distribute this information and these PowerPoints to you. And with that, I was able to visit eCar a couple years ago with Rita and Chris Galvis with Connecticut Housing at a very nice country club. So if some of you are on the line that I met that day, it's good to see you again and great to speak with you. First I'd like to go over the state of the housing market. We really have a lot of challenges this year, obviously, with the COVID-19 pandemic. It's changed the way we do business. Freddie Mac had to pivot to a virtual world, which, along with mostly everybody else within the industry. I personally would travel 60 to 75% of my week on the East Coast from Maine down to Florida. And so it's dramatically changed my life as far as, how I have to raise awareness and educate, realtors and lenders throughout the lending ecosystem. So Freddie Mac has been around for 50 years now. Actually, we're celebrating our 50th anniversary. We were chartered by Congress in 1970 to we're a mission-based organization to promote liquidity, stability, and affordability in the marketplace. And that's why we like to get out there and meet people like yourselves, because realtors, you're at the beginning of the lending ecosystem. The genesis of the transaction starts with you, and then you refer your prospective home buyers to lenders who then take the process through to organizations like Connecticut Housing or Freddie Mac, who offer programs and put the capital into the system to keep it going. So again, thank you for joining us today, and hopefully you'll find this quite fascinating as far as the information we're going to provide. Again, with COVID-19, it's given us a lot of challenges out there. The number one issue is employment. Unemployment spiked in 2020, especially in the lower to moderate income folks. And my end of the business, I focus on affordable lending, and we know there's a challenge out there also with inventory for affordable homes. So so we have a two-pronged issue right now. Unemployment within lower to moderate income folks, and not enough housing to really provide to them out there. So as a realtor, I know that you have more stresses than you ever have before in trying to find the right property for this type of borrower. So hopefully, some of the information I'm going to share with you now will help you with your selling strategies in affecting this process. Freddie Mac, we do a lot of surveys. We call it the primary mortgage market survey, and mortgage rates are at an all-time low. So what is that doing? When rates are low, it makes things more affordable because principal and interest payments, are drastically reduced for the borrower. But what it also does is it's clogged the pipelines with refinances. So I don't know if you're seeing it, in your area, but I am seeing it, throughout the East Coast, that realtors have told me that, the process has slowed down for them because of all these refinances. Appraisals are taking longer, title companies are jammed with loans, lawyers are jammed with loans. And so these are, issues that we have to face and work around, during this type of environment. What we've done as far as responding to the COVID-19 pandemic is that, we're still trying to be out there and provide the, the customer service that, we do provide to our lenders and our housing finance agency partners. And even though we're all working from home right now, we have seen that it really has not hurt our service levels. And, we are able to focus, on these relationships and provide as much help and assistance as we can. With those surveys that I had mentioned, we are projecting that home sales are going to be level and may even increase in 2021. So we're being optimistic as far as home sales and home growth for what's going to be presented to us next year. And at this point, I want to talk about the changing face of the home buyer, diversification that is occurring throughout the United States right now. And we have a very robust analytics department here at Freddie Mac, and they are able to compile a lot of great information for us individuals who work in the field and do presentations. And what we have here is a breakdown of individuals in the United States that will display to you the diversity that is occurring. We took a look at the numbers in 2016 and versus 2018 to show the changes that can occur in a 2-year period. So this is a breakdown in ages, income, FICO scores, and debt. And what we did, we broke it down by non-Hispanic whites, African Americans, Hispanics, and Asians. And then also we broke it down into age groups, the young millennials, the older millennials, Gen Xers, and seniors. And as you can see, African Americans and Hispanics tend to be younger than the overall population. And also African Americans, millennials, and Hispanics tend to have a lower income and lower credit scores compared to the overall population. Gen X has the highest debt level, followed by older millennials. So hopefully, after our discussion, you can take a deeper dive into these numbers. And again, they can help you identify, possible markets and selling strategies for you. And again, as I mentioned earlier, there is a lot of diversification right now within the United States. So this chart breaks down an 8-year run from 2010 to 2018, and again, it shows where the white white population is, Hispanic, African American, Asian, and 2 or more races. The light blue is the white non-Hispanic, and as you can see, in the under 18 white non-Hispanic, within that 8-year period, the numbers are going down. In the 18 to 39 year range, it is kind of level, and in the 40 to 64 year range, you can see a decline there also. If you're looking at the 18 to 39 year old bracket there is a major increase in the Hispanic population, and the Asian population has also increased. The African American population is steady, within that 18 to 39 year old bracket, which, that age group we have determined as, the sweet spot as far as, prospective home buyers and prospective mortgage um, buyers also. This is a very interesting pie chart here. It shows first-time home buyer demographics. And as you can see, the majority is married couple. But here, we've really identified an emerging market for realtors to take a hard look at. Single females are really entering the market as far as home buying, and they have jumped to 18%. That is more than unmarried couples, which are at 16%, and single males, which are still a little bit slow to the game at 10%. So again, some important information here. It was eye-opening when I saw this, and hopefully you'll be able to use this again in setting your selling strategies. One thing that's very important for everybody in the lending ecosystem to recognize is the mortgage readiness of borrowers. And Freddie Mac has determined mortgage readiness to be having a FICO score of greater than 620, a debt-to-income ratio of less than or equal to 25%, no foreclosures and bankruptcies within the past 84 months, and no severe delinquencies, which are 120 to 180 days delinquent in the past 12 months. So with that, we've defined, if you look at the box in the right-hand corner here, for the total population of people that are mortgage ready at 32%, and younger millennials are 47%, and older millennials are 33%. So that will give you an indication, when you're going into a transaction, where your prospective home buyer might be. Now, don't be alarmed by looking at that mortgage week at 49%. That can be just maybe one indicator that they're off. Maybe their credit score is at 615, or the income ratio is at 30%. So with proper education and awareness, we're hoping that mortgage week number, does start flipping into the mortgage ready number. So that, it's very important information here. It's not actual underwriting standards, and it's just an indicator that that your buyer may be able to qualify for a mortgage, because the last thing we want to do is waste anybody's time, whether it be the realtor or the lender, and bring somebody to the table that really doesn't have a shot. So hopefully you'll be able to use this information provided. Again, this is a population and age comparison table chart that hopefully you'll find useful. We broke it down to the two counties that your lending areas are involved with, New London and Wyndham. And we broke it down by age groups here. So you can see that, within the United States, if you're really looking at, the prospective home buyer range, the 20 to 24 year olds, New London and Wyndham County are very comparable to the percentages of the United States and the state of Connecticut. That 25 to 34 year old range, again, you're very comparable, to those percentages. There's really nothing, alarming or abnormal with these numbers. On this chart here, we broke down the average borrower income by minorities. And, what we did is we took a look at the United States, the state of Connecticut, and then the counties New London and Wyndham. and we broke it down by Asian, African American, Hispanic, and white. And you can see the average incomes, in the United States and Connecticut versus New London and Wyndham, based on those numbers. A couple things that really stand out here are, in Connecticut, especially in the, if you're looking at Wyndham County, um, the Hispanics average income in Connecticut's 84,000. Wyndham County, it's actually 67,000. And then with whites in Connecticut, it's 103,000. And in Wyndham County, it's 79,000. So that gives you an indicator of, some lower to moderate income folks that may need the assistance with these affordable programs that we're going to be presenting. This chart gives you an owner occupancy share, with, again, United States, Connecticut, and New London and Wyndham counties. So again, as far as owner occupancy, Wyndham County is much higher than the United States in percentage, and a little bit higher than the average for the state of Connecticut. New London County is right there with the average for the state of Connecticut, and a little bit higher than the United States. So this gives you an indicator of also the renter population, which is the potential pool for prospective home buyers. And again, you'll be getting a copy of all this information to use. And and this is very, very positive as far as the credit scores in the state of Connecticut. If you recall, when I went over mortgage readiness, we were defining that as credit scored 620 and above. Now, in London, the average is 712, and Wyndham is 705, much higher than the the mortgage readiness threshold. So right there, we know that we have a lot of potential borrowers that would qualify for conventional loans in Connecticut. So what we're trying to achieve by presenting all this information and determining who can qualify for loans, we're trying to create affordability by many types of borrowers. So we're looking at first-time home buyers in the very low to low and moderate income ranges. Freddie Mac offers home buyer loans and refinances. We just want to be very cognizant that the demographics are changing throughout the country, and that we want to be at the forefront and be able to meet everyone's needs. One of the primary functions of my job are partnering with housing finance agencies, and Connecticut Housing is a tremendous partner to Freddie Mac. And, I have a very extensive housing finance agency background. I worked for 12 years at New Jersey Housing as the assistant director in the single family division. But quite frankly, I really didn't know much about housing finance agencies prior to coming on board to New Jersey Housing. So it's very important to know where a housing finance agency fits into the lending ecosystem. They started really being born in the late 1960s, 1970s, and 1980s to fill an affordable lending needs within the states and counties throughout the country. In the mid-1960s, Lyndon Johnson was the president of the United States, and he had a vision for America called the Great Society. And with the Great Society, he's most famous for the civil rights legislation and the Voting Rights Acts, which were signed in 1964 and 1965, respectively. But within the Great Society, there was an affordable lending component. And Johnson's administration knew that they couldn't do it all on their own. So that's why they went to the states and the counties to really start promoting affordable lending, throughout the nation. And with that wave, as I mentioned earlier, Freddie Mac was chartered in 1970 to assist with providing liquidity, stability, and affordability to the marketplace. So what would be a better partner with Freddie Mac to achieve these affordable lending goals is to partner with, Rita's Connecticut Housing. And with that, we provide liquidity and programs to Connecticut Housing to put out there to their lending partners like Liberty Bank, and they can use these products to help us meet our affordable lending goals. So what we did, we launched a program called HFA Advantage, which was specifically made for lenders to use through housing finance agencies. So a lender like Liberty Bank cannot use HFA Advantage and deliver it directly to Freddie Mac. This program has to go through Rita's Connecticut Housing. So it's a 3% down program. It's 97% LTV, and that makes it much more affordable than a FHA loan, which is 3.5% down. We allow for 105% total loan to value, and that allows for Connecticut Housing to put a down payment assistance second mortgage behind us if they need be. And as far as income limits and education requirements, we defer to Connecticut Housing to set those requirements. And one major affordability factor on the HFA Advantage loan is that it has charter level mortgage insurance, which I'll illustrate for you, the savings for the consumer. So again, as I mentioned, it's a really good alternative to FHA financing. So so if your lender is not using this program, we want you to encourage them to, or you can contact Pam at the end of this discussion, and then become a referral source for Liberty Bank, because they do offer HFA Advantage, and we want you to know that these these programs are available to your prospective home buyers through Rita's CHFA. So the HFA Advantage program, again, it's our program that can only be provided through the Connecticut Housing Finance Authority. And one thing we really like to stress, if you look at this slide all the way to the right, is Freddie Mac prides itself in support and training. That's why we have webinars like this. And Rita knows that I've spent many many miles on the road in Connecticut visiting lenders and realtor associations when we were allowed to travel. And the whole scope of this is that you as a realtor, or Liberty Bank as a lender, or Connecticut Housing, or Freddie Mac, we cannot perform our fiduciary responsibility to the prospective home buyer in promoting the best program possible to them if we don't know about it. So again, the whole scope of this webinar and our training is to educate and raise awareness. So this slide will give you a nice little indicator of what the HFA Advantage program is about. It's for one unit primary residences only. It can be used for purchase and no cash out refinancing. That is up to the housing finance agency to determine if they want to put it out there for purchase or refinancing. Again, 3% down, 97% LTV. It's underwritten through our automated underwriting system, Loan Product Advisor. So the lender, like Liberty Bank, would have to get an acceptable decision through LPA. There's no reserves required. As I mentioned, income limits and educational requirements are determined by Connecticut Housing, and we have flexible mortgage insurance options, which gives us much more flexibility than an FHA loan. So this is really the home run here on this slide. Standard mortgage insurance on a 3% down program through conventional is 35% is what the consumer pays. When HFA Advantage, they pay 18%. So that's almost half the savings in mortgage insurance that your prospective home buyer will save by going with this loan through Connecticut Housing. tremendous savings, tremendous opportunity for the consumer. And again, in comparing HFA Advantage to an FHA loan, really the pluses that we have, when an HFA Advantage on the conventional side, mortgage insurance ends at 80% LTV, so it sunsets. FHA loans, it stays on for the life of the loan and is very costly for the consumer. So with the HFA Advantage, they just have a lower monthly premium. On an FHA loan, they have the costly upfront premium that they have to pay, and then their more expensive monthly premiums. So again, FHA does have, it's when we realize that, but we just do not want consumers who can qualify for a conventional loan and save a ton of money not know about this program and not have it presented to them by their. We're getting feedback from somebody there. Okay, thank you, Greg, for taking care of that. Okay. And what we have here again are 3 programs that we offer for lenders to use. I talked to you about HFA Advantage. Lenders like Liberty Bank use that through Connecticut Housing. But Liberty Bank can also offer 2 other programs to your prospective home buyers, the Home Possible and the Home One program. And Liberty Bank would deliver these directly to Freddie Mac. Home Possible is also our 3% down program, but it has restrictions on area median income, and that's at 80%. And it does have reduced mortgage insurance at 25%, so it's not as attractive as the HFA Advantage at 18%, but there is still a savings. And Home Possible is available for 2 to 4 units also. Home One income restrictions, it is available for 1 unit only, and the consumers pay the full 35% MI for the 3% down, but it is also available through Liberty Bank. So at this time, I'd like to turn it over to my great friend and business partner, Rita Bellinger at Connecticut Housing. And Rita, time is yours.
Thank you, Jim. Everyone hear me okay? Thumbs up. Okay, thank you. Thank you everyone for attending today, and really it's such a privilege to be part of this absolute dream team. CHFA is not a direct lender, so obviously we are the wind beneath your wings between the realtors on the front lines, between Freddie Mac offering the products that best meet the needs of your buyers, and Liberty Bank delivering those services. So we're going to see if Jim can keep up with me with the slides to give you as much information as possible in as brief amount of time as possible. So CHFA is a self-funded quasi-public organization dedicated to alleviating the shortage of housing for low and moderate income families and persons in the state. So the key thing there is we are self-funded. We raise our own funding for our mortgages. We do not utilize taxpayer funds. Okay, so our history, we just celebrated our 50th year anniversary last year, again, as a self-supporting quasi-public agency, and really for expanding housing opportunities for Connecticut residents. Last year alone, we assisted over 3,200 individuals become first-time homebuyers through our low interest rate mortgages and second loans for down payment assistance. So this is a nice graphic of the life cycle of how we actually fund our loans. So we receive bonding authority through the state. That authority allows us to issue our tax-exempt mortgage revenue bonds. They're sold on the open market, always oversubscribed. And with the proceeds of those sales made available to us, that's what funds our mortgages at a below interest rate. So how is CHFA different? So the first thing probably is that people may or may not know, we do not self-originate, right? We count on our partner lenders who will work with the buyer from start to finish. They'll originate, process, and underwrite our loans. And when they are clear to close, CHFA may need to review some. If there's other situations where CHFA does not need to review a file prior to closing, so you're pretty much in the same timeframe processing with the lender, whether CHFA is involved or not. And the types of lenders that you'll find on our approved lender list will include banks, mortgage companies, and brokers. And again, one of our biggest advantages is that below market interest rate. Our interest rates will update at 9 a.m. daily. You can subscribe to receive that directly. So the benefits of having a loan partnered with CHFA. CHFA is not a product by itself. We're an agency that enhances the product that your buyer is already getting with that lender. So the advantages of having that loan partnered are they would use the CHFA below market interest rates that are published publicly on our website. Only if someone's getting that first mortgage partnered with CHFA, then our CHFA approved lender could see if they qualify for a second loan directly from CHFA for any remaining down payment. We offer all types of free homebuyer education. There's targeted areas in the state that we'll review. In those targeted areas, we offer incentives. And then we have some specialty programs. They're not products by themselves, but eligible individuals may be able to receive a discount to the CHFA interest rate. So our website, chfa.org, it's a great thing to save as a favorite, keep it as a resource. Any and all of our information is published on our website, whether you're a potential homebuyer, realtor, and we have some dedicated things for the realtors on there. So do save it, chfa.org. Make sure it's not chfa.com, that's Colorado, and we'll go over some of those highlights. So the first thing right on the homepage, if you scroll down, stay in touch with CHFA. We really encourage anyone and everyone to enter your own email address as we publish news, announcement, changes, so many things, fluid during this crisis. You'll receive those notices right at the same moment. We publish them to our lenders and any other partners. And you can also sign up for the interest rates there. So it's a great way to keep in touch and know what's going on directly from the source. So some of our key website features, if we scroll down on that homepage under the picture, would be Homebuyer Education. There's a quick link to access all of our forms of homebuyer education. There's another quick link there on the left under the homebuyer section where they can get a quick link of the approved lenders to select a lender that's approved to partner with our programs. Under the middle section for lender real estate agents and counselors, there's a quick link to the sales and income limits in the traditional PDF list form. There's a very nice interactive resource map with tabs of topics up above, and you can click on any town in the state right down to street level and see all of our information as it relates to that area. Probably the most popular feature we added to our website for realtors under that middle section is loan status information. If a file does need to be submitted to CHFA, it allows you to type in the information, the property address or the loan number. That's not private, and that will tell you the exact status of that file. So we're all about communication and transparency. So CHFA approved lenders, there's two ways a buyer may select a CHFA lender to work with. If they click on that quick link, that circle there that was on the homepage, then the list on the left will open up in the alphabetical form. Sometimes buyers will ask us, is there any other way to select a lender other than alphabetically? Absolutely. If you click on the word lenders on the homepage, it'll open up a lender activity report. We keep a real-time report of lenders that use our programs more frequently. So that may give someone a different way or higher comfort level with partnering with one of our lenders. Homebuyer Education, if they click on that quick link, you'll see all different forms of homebuyer education. They're always free. They're all being offered in a safe online environment at the moment. And if a customer is has a loan in process with CHFA and they're truly taking an online course, which is a module where you're reviewing information and answering questions, they access that online course directly from our website also. So CHFA, we sell tax-exempt mortgage revenue bonds. So based on those bonds, we have some requirements. One is a first-time home buyer. That's either someone that's truly never had a home ownership before. That includes someone that has not had home ownership in the past 3 years. So they've either sold or quit claim a property. If someone has owned a home in the last 3 years, they may still be eligible to have a loan partnered with CHFA if they're purchasing in one of our targeted areas. Income limits, we'll see that income limits vary by town and county, and it's based on how many people will be living in the household. So 1 to 2-person household, or 3 or more. And once you arrive at that number only goes against the note signer. So key information. And there are times when the income limit may be waived. Sales price limits. Sales price limits will always be in effect. They also vary by town and county, and they may be higher between new and existing homes, and also homes located in targeted areas. Homebuyer education, some form of CHFA free homebuyer education is required for any buyer that is having their loan partnered with CHFA, but certainly anyone, whether their loan's partnered with CHFA or not, or is early in the process, can participate in our free homebuyer education. So the benefits of purchasing in a targeted area. So in a targeted area identified by the federal government where they'd like to see more home ownership, if the property is located there, the CHFA rate, regardless of the product, would automatically be discounted by 0.25%. The first-time homebuyer requirement may be waived only if they are not receiving a conventional loan. So if they're getting a government loan only, they don't need our second, I'm ahead of myself. First-time homebuyer requirement may be waived in a targeted area, period. It doesn't have to be 3 years since home ownership. However, they can never retain ownership of another property at the time of closing. So even if they're having piggyback closings, I'm closing on the sale of my existing home right before I'm closing on the purchase of my owner-occupied CHFA financed home. Okay, now back on track. Income limits. Income limits may be waived unless the buyer also needs our second mortgage for assistance, or they're getting any conventional loan through our program. So if they're getting just a government loan, FHA, VA, or USDA, don't need the second source of down payment from us, the income limits may be waived. Okay, so how to find if your potential property is located in a targeted area. So again, on our website, the top graphic is our interactive resource map. There's a tab at the top of it for targeted areas that'll give you an idea of where they're located, and then you can expand that right down to street level. However, targeted areas are identified by a census tract. So the bottom graphic is a snippet off the income and sales price limit list format, and that's kind of like an easy visual way to see, like if we're in Bridgeport, it's all areas of Bridgeport. If you're in another town, it'll give you the specific census tracts where a property may be located. That'll trigger if they're eligible for those targeted area incentives. So how do we find out the census tract of a property, right? Because then we have to look at the list with that. So it's a federal designation, so we're going to go to the federal website, ffiec.gov. We're going to type in the property address. For Connecticut, especially critical to use the zip code. We just love to have villages, boroughs, and all kinds of things, and it can really skew the results. So by always using the zip code, you're going to ensure that you're going to get accurate results. And then you'll see on the left there where it's circled, once we have the property address, it will give us the census tract code that we would have looked at that previous slide to see if it's in a targeted area. Okay, so our income limits. So again, this is the easier visual list format, but you can also click on the tabs on that resource map just to get it by town. But looking at the list format, it's an easier way to see the towns. There's 2 columns for income limits, 1 to 2-person household, 3 or more. Just about how many people will be living there. Never anything about everyone in the household's income. Just number of people living there, arrive at the number corresponding to the town they want to live in, and that income limit is only applied against the note signers. Okay, so the CHFA income limits, when you deal with a program such as CHFA that has an income limit, the lender has to do an additional step for calculating income other than when CHFA isn't involved. When they have income limits, we said it's only the note signers. But for the income limit eligibility, it's any and all sources of income for them, which may be quite different than stable and dependable sources of income used for qualifying or repayment. These are just some examples of income that would need to be calculated in that annual income calculation, such as child support that might have a short term remaining, a second job that may have just been started and not seasoned, just things like that to consider. Okay, and our sales price limits, this is just the page 2 of that PDF, and you'll see based on the town and counties, they may vary between existing and new, and if they happen to be located in a targeted area, it may be higher than the rest of the town. Okay, so property eligibilities. What types of properties can be financed with a CHFA loan? They include single-family homes, townhouses and PUDs, condominiums. Condominiums are very easy. People make it complicated. Very simple. That condo, CHFA does not have a separate condo. All condos do not have to be FHA regardless of the product they're using. What it is they have to be approved or eligible by whatever first mortgage product your buyer's using. So if your buyer only qualifies for FHA, it needs to be FHA approved, which would include spot approvals. You know that Fannie and Freddie require the lender to review the condo docs, and they'll simply certify to us that it meets those guidelines. That being said, if you do run into a condo that is deed restricted for affordability, sometimes you'll even see CHFA mentioned in that deed restriction, and it's not acceptable to another investor or insurer. If the lender supports the file, feel free to send in those deed restrictions to CHFA. Our legal team will review them and we will participate if we can. Multifamily homes, being 2 to 4 units, must have been residential properties for the last 5 years. That just means it gets confused. People think they had to have been living in it. No, that just means they can't be recent commercial conversions, okay? So multifamily homes may still be eligible. Again, our properties always have to be owner occupied, so your buyer would be agreeing to occupy one of those units in that multifamily as long as they have a CHFA loan. Newly constructed 2 families are allowed in target. Okay, so what products can be partnered with CHFA? So conventional products, Fannie Mae and Freddie Mac both have a specific conventional loan that has added advantages than just the conventional Freddie Mac or Fannie Mae loan not partnered with CHFA. As Jim said, this HFA, the prefix is for Housing Finance Authority, has some specific advantages, is only available in that partnership with us. So they can either, both the Fannie Mae and the Freddie Mac product, finance up to 97%, and they both allow up to 105% for all combined sources of funding. If you're combining the first mortgage with our CHFA down payment assistance, that combination is capped at 100%, and then it may be eligible for additional sources of subordinate financing behind it up to 105. The government products that can be partnered with CHFA, no difference in their guidelines than without us. FHA up to 96.5. Again, they allow subordinate sources up to 105. CHFA DAP combo would max at 100%. VA and USDA are both 100% products. That doesn't change partnering them with us. So all loans partnered with CHFA are required to be 30-year, fixed rate. They have to use the CHFA interest rate. They cannot price adjust against it. They all have a 1% origination fee. Misconception about that. That is not a CHFA fee. That is a borrower paid, lender retained fee for originating our loans for us. It ensures that they're getting the lowest rate possible with the CHFA rate. Again, they all agree to owner occupy the property. For how long? As long as it's financed by CHFA. There's never a prepayment penalty to sell or refinance, but they agree to occupy it as a primary residence as long as it has our loan. Non-occupant co-signers are not eligible on CHFA loans, and key thing to remember, no additional names may be added to deed. We're here to the deed. We're here to serve a targeted income population, and if I can add my non-signing spouse to the deed who may be over income, that's how he realized home ownership is through our program. So that's the reason that is not allowed. Until further notice, all CHFA loans are complying with all first mortgage temporary guidelines due to the crisis. Again, you can sign up for these bulletins, news, and announcements right on our website. They really just mirror as first mortgage guidelines are coming out, changing, continuing, anything that, we're just keeping up with everything. You just know that you can't bypass first mortgage guidelines, and we're also complying with any temporary alleviation of any restrictions or anything else with the current crisis. So for the Freddie Mac HFA Advantage and the Fannie Mae HFA Preferred, some important changes happened last year that could affect the cost to the buyer. It could increase the cost, okay? So lenders have to do an additional calculation that came out based on this. And when they do the qualifying income, if the borrower's qualifying income using the Fannie Mae and Freddie Mac annual median income chart exceeds 80%, it would have increased cost to the buyer. So CHFA, as a result, came up with a CHFA conventional product. Just know that it allows your buyer to continue on with a conventional loan partnered with CHFA without the additional costs. Any conventional loan, the maximum debt to income ratios without our CHFA down payment assistance, maximum ratios are 45%. That's 45% front end for housing and 45% total debt income. Income limits are not waived, reminder, on any conventional loan, that even if your buyer's purchasing in a targeted area. All CHFA mortgage programs, of course, as soon as you say these things, there's been even recent changes. Maximum ratios without CHFA DAP, right? So a first mortgage only partnered with CHFA. 45% max housing, 45% total debt to income. If you add in our second loan for down payment assistance, of course, it makes it more risky. You're financing up to 100%. Then the risk factors, the maximum ratio is 35% and 43% back end. We say no exceptions. However, hot off the press, there have been some expanded guidelines for teachers programs that we'll touch on in a minute, but we don't have the latest of the changes. I'm just going to tell you here. There's some times when teachers, if they have current outstanding loans, student loans, may be eligible to go up to a 50% only if it's an eligible teacher with student loans in repayment. Okay, so for the HFA Advantage and Preferred, Jim kind of touched on it, but you'll see this is an example of the significantly reduced PMI coverage versus a conventional loan not partnered with CHFA. So your buyers save on the lower rate, they save on the PMI, they save all along the way. So for conventional loans, lenders have to do a few calculations. They first, with that change to Freddie Mac and Fannie Mae, they have to do that area median income qualifying repayment calculation. They're going to see it right in their findings or use Fannie Freddie's chart for the calculation to determine if that qualifying income exceeds 80%, they wouldn't continue on with the reservation under those two products, but CHFA responded with a conventional loan. Your lenders are very familiar with it. They'll just continue on with the CHFA conventional product. If the qualifying income is less than 80% on those charts, they continue on with that Fannie Mae or Freddie Mac reservation. And always, for every loan, CHFA income limits, remember all sources for the note signer, that will always be in place and is never waived unless they're getting a government loan in a targeted area. And this is just a graphic of the Fannie Mae Freddie Mac chart that they use for the annual median income. If you have any further questions about that, Liberty Bank is our resident expert and they can guide you further. So in response to those changes, CHFA launched a conventional, even in this crisis, we still try to, effectively in a timely manner respond to any adverse changes, any challenges out there as positively as possible. So even us all working remotely, we launched a conventional loan program. It just allows your buyer to still have the advantages of all of a conventional loan partnered with CHFA without additional cost. And this is a sample of what the PMI coverage would look like. It's still significantly less than a conventional loan not partnered with CHFA, and it's just slightly higher than the Fannie Mae and Freddie Mac conventional loans that are under 80% LTV. So we still try to keep it as affordable as possible. Your lender will still do all of the normal qualifications that they do, and when they run the loan through their automated system, they'll get an accept. It's just giving them an alert that their qualifying income exceeds that chart, and it just allows them to move forward with us. So the CHFA Homebuyer Specialty Programs, again, these are not products by themselves. So your buyer is still working with the lender to determine what mortgage product they qualify for, right? Just like without us, a conventional loan, a government loan. Second step will be, do they meet our bond compliance? Can that loan be partnered with CHFA? And then the next step, like they're not doing enough work for us. They're trying to give your buyer any advantage that they can. These following groups may be eligible for a reduction in the interest rate by 1/8. So if you have a police, teacher, or service member, if someone in the household of your buyer is disabled, not just the note signer, if anyone's coming out of public housing as an applicant, any of those groups may be eligible when they work with the lender for 1/8 off the rate. Now, we said previously that if we buy in a targeted area, they get 1/4% off the rate. So in general, the lender's gonna apply the greater discount, okay? Just know that you can't add up the different discounts. I know you're already thinking way ahead to do that. Okay, and just know that we have a 203K product. It's only available with one lender to partner with us. That's when, you know, if just like a 203K loan without us, a house in identified need of repairs, where the repairs are financed into the loan and dispersed after closing. CHFA did administer a mobile home program. We did that directly through Capital for Change, but it's pended during this crisis for pending renewal. There's just so much crisis going on and funds have been diverted. Okay, so our other huge advantage, right? Our second mortgage for down payment assistance. So the first thing is, number one question I get, it is only available if someone is eligible for their first mortgage to be partnered with us. I actually love getting the calls where I'm working with, you know, XYZ lender, not a CHFA lender, and I only need down payment assistance. It still gives us an opportunity to, you know, just have them talk to a CHFA lender. If they're getting the best deal possible, okay, which of course they can't because our rate's lower. So it still gives them the opportunity to partner with a CHFA lender right before closing. And then if that first loan can be partnered with us, then our lender can offer that second mortgage for assistance. It allows them to purchase with 0% down if they either need to, right? The low interest rate is always mirroring the rate of the first mortgage. So if that rate was dropped by 1/4% in the targeted area, that rate drops for that second mortgage as well. It's always 30 years. It is truly a fully amortized second mortgage. People think it's a grant, it's forgivable. It's none of that. It's a very small payment, but it's a second mortgage. No prepayment penalty. They can pay it off at any time. The minimum loan amount we can write for a DAP is $3,000, and the maximum combined loan to value with any first mortgage product is 100%. Know that, you know, the lender's going to follow whatever first mortgage product guideline. Excuse me, if any other subordinate sources of funding can be behind us, up to a maximum of 105%. So just know that, you know, we play well with others. Some common examples of some community seconds that are acceptable to CHFA. Really, there's been like over 75 of them when, somebody scribbled on this, when lenders partner with any other sources of funding, and we have approved them. Liberty Bank is a lender that truly offers like probably the most partners of subordinate sources of funding. HDF, Yale New Haven has an employee program, Equity Builders, anything and everything that helps expand their buying power and make it more affordable. So again, some available resources. So direct links to the HFA product on our website. Our underwriting and operating guidelines are all published on our website. In general, a lender's just following the guidelines of whatever first mortgage. You can't bypass them. Very common question I get from realtors. Can this property go CHFA? I don't know. It's not enough information. That's usually prompted by an FHA issue, right? We always have to go back to the buyer. If the buyers only qualify for FHA, the property needs to meet FHA guidelines, whether CHFA is partnered or not. Again, a direct link to the bulletins on our website as we publish them, or we encourage you to sign up to receive them directly. Any questions, feel free to let me know. I'm happy to participate. I'm always here. Our entire staff, we are open for business. That's another misconception. If you go to chfa.org, first thing that pops up, hello, we're open. There's been no interruption in services, products, nothing. Our entire staff is working remotely, and we're more accessible than ever. And really, thank you for having us participate.
Thank you, Rita. I have a question for you.
Yes.
Has the number of mortgages you guys have processed increased this year? Is it less, more, same?
There was a dip during that initial crisis, and other than that, it's been very high. I don't have like my number year to year. Because the refinance population has been so big, some has been a delay with lenders just because they have so much volume in the refinance. But just like it's kind of weird, you know, in a crisis, even though some people will experience the crisis, and we're administering an emergency mortgage assistance program and rental assistance during this crisis, just, you know, in our spare time, we're doing that too. About 10,000 people we're assisting with both of those. But there's been an uptick in the purchases too, because other people, as some people can't sustain those mortgages, other people are realizing the advantages of still the affordable rates and the buying opportunities. So we've seen it both.
Yep. Another question I have is, I'm not a realtor, I'm not out in the field doing this, but I do hear sometimes, and you can speak to this but the question is, why does this happen, and why would a seller take a conventional mortgage application buyer over one of these mortgage options, and why?
So that is a very good question that I always have for realtors, and I encourage realtors to take our free CE course to learn more in depth, because just like Susie just pointed out there, why should they take a conventional over a CHFA? They're separating out as if CHFA is a different product. It's not. You can get a conventional loan just made better by a lower rate. How is that a disadvantage for a buyer? That is an advantage for a buyer. And because they have to go through vetting of required homeownership, where just that non-CHFA partnered buyer maybe didn't, they may be more likely to fail before the deal even closes. So there is absolutely no reason not to, you know, have a deal go with CHFA partnered. And a lot of loans don't even come to us for review first. It shouldn't take longer. Nothing. There is no reason why.
So the vetting process doesn't take longer than a conventional loan?
The process is exactly the same. A lender originates, processes, and clear to close. Only loans that have the DAP on them also require CHFA to do a compliance review of some of those documents, which is taking 24 hours or less. So to me, no, they shouldn't take any longer. And if they don't have the DAP, there's no difference whatsoever.
Sounds like that was a myth.
Susie, I'm gonna hold those questions. I've got actually a few of my own, but I want to let it go to Pam and Ann for their perspective on this.
I mean, this question is a perfect segue to our business partners at Liberty Bank right now. We're really pleased that Pam and Ann could join us today to go over Liberty Bank's affordable housing programs and the services they provide to consumers in Connecticut, and specifically the counties that ECAR serves. So with that said, Pam and Ann, time is yours, and thank you for being with us today.
Great. Good afternoon, everyone. And thank you, Jim, so much for inviting us to be part of the presentation, and ECAR for having such a valuable program. Affordable housing is a really top priority at Liberty Bank. It's one of, I come under the community development section of the bank, and it's one of our key priorities to work with these and nonprofits and individuals throughout the community to make sure housing is affordable for everyone. So Jim, when you started talking earlier today about single women being one of the top demographics, I just wanted to bring up that one of our new programs that Ann and I are working on is single ladies home buying programs. So if any of the realtors out there would like to partner with us, we're going to just be doing some workshops across the state for the single women who are out and looking and trying to buy a new home. We do a lot of home buying programs. Another point that was brought up during the talk so far today was having people be mortgage ready. We do home buying programs. We do programs to get people credit ready. Tonight, I have a program at Waterford Library, virtual, on credit and building your credit. So if anyone has a client who needs a credit score boosted a little, they can go to Waterford Library's website or Liberty Banks and register for tonight's program. But so we're always working to try to help people get ready to be homeowners. And in that process, we've gone out and talked to different community members, different individuals to find out what is really needed. And we came up with a few programs of our own to try to help with the make mortgages more affordable for individuals. So one of our key signature programs is the Good Neighbor Program. This program allows home buyers to purchase a home up to 97% down. And they, the key here is the mortgage insurance is paid by Liberty Bank. With this program, we also offer 0.5% off the current conventional rate. And one of the beauties of this program too is there are no income restrictions. This program, though, the key is that it's only offered in low to moderate income census tracts. So it's really to help build up these communities that really where homeownership is at a low point, where people are renting and feeling, you know, homeownership is not going to be in the cards for me. It gives an opportunity to help these communities get people into a home of their own. Jim? So these are just some more information about the Good Neighbor Mortgage Program. And we are going to make all these flyers and slides available to everyone. So some of the program details, it's eligible 1 to 4 families and condos. There's no income limit. It has to be owner occupied, a minimum FICO score of 640, a maximum loan amount of $500,000, and the LTV is 97%. So it's a really great program. The key is that the lender paid mortgage insurance is also key for the life of the loan. So that's great too. We also give a credit towards the closing costs of $300. And there is one other program where that the cost to closing could be $2,500, but that's in a very limited census tract. So if you have, the loan officer would be able to work with any borrowers to know if their the property falls into the proper census tract. Slide. So also, as we were talking out in the community, one of the other issues that came up were that in the downtowns, especially in New London, Willimantic, Norwich area, there are a lot of older properties that maybe had a storefront that were getting run down, and so the cities and towns are saying, how can we help to revitalize our neighborhoods? So we came up with the Good Neighbor Investment Mortgage. Can you go to the next? slide. And so this was to help with housing stock and to address the needs of investors. So this is a special program that it can be for 1 to 4 units for low to moderate income areas again. So it has to fall into the census tracts and they must be a Connecticut resident. So these mixed use properties, it's a really great way to help build up the cities. If you have a storefront on the bottom, apartment or 2 above, the residential component must be greater than the commercial space. And there is a little, the appraisal fee for mixed use properties will be used. This one you have to have a 700 minimum credit score. It does not have to be owner occupied. And it can be either a purchase or a refinance. So it has a lot of flexibility with it. And the loan to value is 75% for 1 to 4 units. And this is if you need a cash out refi. The reason the cash out refi has been useful in this area is a lot of times some of the older properties in a downtown, maybe a person purchased at a very low price, but then they need some fixing up. And so there's enough cash in order for them to refinance and get some cash out and do the repairs that are necessary. Next slide. These are just some of the guidelines, but we'll make sure we have all of this information available to you. So then after we came up with the Good Neighbor Investor, we then still were listening to people, and the biggest criticism, or not really criticism, but add-on people were looking for was, well, what if I purchase one of these properties in a city and it needs rehab? We can't just move in. It's not move-in ready, and we don't have the extra funding to make the repairs necessary to, get this property up and running. So we came up with the Good Neighbor Investment Rehab, and it is to help revitalize the neighborhoods as well. So these properties now you can buy with extra funding to do the rehab work as well. It can also be non-owner occupied and held in an LLC. There's no income limits. And again, they do have to be in a low to moderate income area. So these are just some of the possibilities for some of the properties that we've recently seen. Next. Next. So our Good Neighbor is our Liberty Bank signature program, only available at Liberty Bank. But we also do partner with, as we've talked earlier, with Freddie Mac, CHFA, FHA, USDA, VA, and a multiple amount of down payment assistance programs. So as Rita had said earlier, with the CHFA mortgage, things can be layered on to help make the loan more affordable for a buyer. So we also have CHFA DAP for down payment assistance. We participate with Fed Home Loan Bank's Equity Builder program, which is a grant for down payment assistance. For Smart Moves, Live Where You Work, those are HDF programs. House Hartford, New Haven, and other homeownership programs throughout the state. So like Rita said, a lot of times a buyer still needs some extra help, even if they are a first-time home buyer and qualify for CHFA mortgage. An example is we had a home buyer in New London who was a first-time home buyer purchasing a home, a very limited income, and they still needed additional funding. So the loan officer worked with the realtor to help the seller pay some of the closing costs. He worked with her to also get the Fed Home Loan Bank Equity Builder grant. And her husband happened to just got a new job at Electric Boat and was working in New London. So he also qualified for Live Where You Work down payment assistance. So with all of those programs layered together, the homeowner was able to, purchase the home. So that's one really great thing with Liberty Bank's loan officers. They are really worked hard with the borrowers to help them find all of the options available to get them in the homes they need. I don't know, did I miss anything, Ian?
No, Pam, that covers it up pretty well. I think one of the questions that was addressed is why would anyone ever not go with CHFA or the HFA program? And a lot of times they'll come to us because they're over income. And one of the things we have is we don't have any income limits on our Good Neighbor products. So that's one reason that we would not put them into a CHFA or a HFA program.
And another, that just reminded me, Susie's question to Rita is why would someone steer them away from a CHFA loan? A lot of times I'm working with just individuals who want information or education on home buying. And I'll run into someone and they'll say, oh, I'm buying my first house. And so then of course I have to say, well, where are you getting your mortgage? What kind of mortgage? Just, questioning. And they aren't getting a first-time home buyer loan, and they are a first-time home buyer. And I'll say, you can save close to $100 a month on your mortgage payment. Oh, well, I'm happy where I'm at. And I'll tell them, you know what, do me a favor and just talk to someone and get and see. And sure enough, later they'll come back to me and say, thank you, I got a CHFA mortgage, and my payment is so much less. And when you figure out $100 less a month over 30 years, it's a huge savings, especially for someone in an affordable, situation. So.
Yeah, the one thing I'm going to do is, since we have a rebroadcast of this being distributed and there's going to be a lot of time shifting and replays on this, I want to reach back to what Rita said, because some of the links that are in chat aren't going to be available on that broadcast. So Rita, I used to know the number, but I think it's 90 something lenders are on the CHFA list, correct?
Yep, there's approximately 80, yep.
Okay, now I'm going to focus on eCar because we're hosting it. We have the link to affiliate lenders like Pam and Liberty. If you go to easternconnecticutrealtors.com/resources and affiliate services /affiliate services, mortgage lenders lists those. Liberty happens to be one of, Rita, how many? 10 that are direct lenders? They do the direct underwriting?
Yes, yep, there's approximately 10 right now.
And those on your site are highlighted in blue.
In green, yes.
Oh, green, okay, change the color on me.
That's okay.
So that's really good. And I'm just going to channel a few questions that I know the 900 or so agents here in Eastern Connecticut, we're almost hitting 1,000. But I know that one of the most important things is that as a real estate agent, your buyers are always looking to us to be the guide, to be the Sherpa, but we don't have to be the expert at lending. And if you look at Jim's 70 plus slides, and it's going to be shared here. When Susie posts this link, you're going to get links to the slide deck. The interesting thing is that we as agents don't have to be experts. We need to be able to refer the buyers to the experts. And the one thing that I want to ask, and a couple of high level questions here, Rita, with your presentation, you said that CHFA raises the private funds through bonding. And I'm curious to know, Jim is, Fannie Mae, and I always thought of that being the
Freddie
Fed.
Mac.
I'm sorry, Freddie Mac. Okay, your kissing cousin, right? So
Yeah.
my question about it is, so that connection between CHFA and Freddie Mac, is it you are providing you're not the Fed window, so to speak? Are you providing the insurance, or where does that connection between CHFA?
Well, our connection with CHFA is a partnership, Greg. And again, we provide liquidity. So we came up with the program HFA Advantage specifically for housing finance agencies to use. And what Rita's CHFA does is they offer that program specifically to a lender like Liberty Bank. Liberty Bank originates the loan, processes the loan, funds the loan, and then delivers it to Connecticut Housing. And then eventually Connecticut Housing delivers that to us, and then we buy the loan. So we provide the liquidity to Connecticut Housing to sustain their program.
So you're the man behind the Fed window.
Yeah.
There we go.
Not specifically the man, but for the organization, yes.
And an interesting thing on the CHFA website that I think a lot of the agents need to know is that if you're working with a lender who's telling you certain things in terms of delays, there's a stigma sometimes of the first-time homebuyer programs can be lengthy and very difficult and very hard. And I have to say that transparency that Rita spoke to, it's right there. There's a link that I shared with everybody on today's call live, but it's important on the website at CHFA, the CHFA.org/realtors/loan-status. That you can see where's the loan. So if it hasn't been pushed up to CHFA, it's not CHFA's problem. It shouldn't be labeled as CHFA's problem. It may be the borrower's slow in getting information to the lender, but that process of originating has to happen at the Liberty Bank level or at hopefully another affiliate of eCars level. And then it goes to CHFA for that final turnaround. And right now, your turnaround time, I think, haven't looked lately, but I think it's like 3 days.
It's been less than 24 hours or 24 hours or less since this whole crisis. And thank you that's exactly why we put it on there, right? To dispel any myths, rumors. It shouldn't take any longer. They should be much more well vetted and prepared. And yes, our partnered lenders. So when you're writing contracts, you want realistic dates. You're going to check with your partner lenders as you normally do. What is your turnaround time so that you're writing realistic dates? No difference if it's partnered with CHFA. And that's exactly why we encourage realtors to take the free CE course, and they learn all of this in depth. I can't tell you how many realtors in that class have said, I might have started as a listing agent and my seller would always take another deal over something partnered with CHFA. Maybe that other deal fell through and plan B with CHFA went smoother, and they became, lifelong loyalists and supporters of CHFA.
Well, and CHFA used to have that label, stigma of it had to be a first-time home buyer, and it's 3 years if you haven't owned a home in 3 years. So that's a critical one. There's two other questions that I had, and it's go back to Jim's slide deck. If you could pull up page 12, your minimum requirements. I have a question on your slide deck, slide 12. Are these requirements different now versus 2007 and 2008? And specifically, the reason why I'm asking this is we're here to promote not just put people in houses and get the deal done, but it's responsible home ownership. And the key is that in this minimum bar, this minimum threshold, did all of these the FICO score, debt to income, no foreclosures in 84 months and bankruptcies, did those exist in 07, 08, Jim?
Yeah, they are consistent, Greg. So
okay. So they haven't that has not changed, and it hasn't necessarily gotten ramped up, so to speak. If you go down 2 more slides, an interesting one in Eastern Connecticut that I think is pretty cool, and it proves that real estate is local. Take a look at New London and Windham County. I am impressed to see that the highest income for the county, Hispanic in New London County. And then the highest income in, I'm sorry, did I have that backwards? The highest income in Windham County is the Black income, the Black borrower.
Correct.
And so that's kind of a cool thing to see that, we've got really, Eastern Connecticut's employers and people working there's some equality. It looks like we still got some work to do with Hispanics, though, in Windham, and the Asians overall in the U.S. were the top. So it's crazy. It's almost upside down here in Eastern Connecticut.
Yeah, very, very interesting, statistics, and that's why I really enjoy, sharing these with realtor associations throughout the country, because like you said, it really is specific to the relevant area that you do business in. So and again, I hope that your members find this information valuable and useful, and then you feel free to post this on your website or send it to your members via email, however you see fit.
Okay, and definitely Susie, when she posts this, we'll share it on the eCar members, the broker side and the public side of the sites with the slide. Is it okay to share the slide deck? Okay.
Yes, absolutely. And due to time limitations, at the end of the slide deck, there's multiple Freddie Mac resources and tools for realtors to use, which I didn't have a chance to review. So please, take a look at them after this discussion. They're very valuable, and they don't cost anything. They're the right price. They're free. We don't have anything to sell at Freddie Mac. Again, we're here to provide this information to you just for educational purposes and raising awareness. So again, I hope your members, find that this information is valuable enough for them to put into their toolkit to help them with their daily selling strategies.
Well, I have a question for Rita. Probably 20 years ago, I had a CHFA loan, and if I'm not mistaken, the PMI insurance that was tacked onto the loan was like a built into the loan up front. So I learned that like a couple of years later. I got an inheritance, I refinanced, but I had, paid up front for this full PMI that I didn't get any of that back. Is that still the case, or has that changed? You're muted.
Sorry. PMI is directly connected with the first mortgage product. CHFA is not involved. So whichever structure of the first mortgage product, the PMI goes directly to that private mortgage insurance that's insuring the lender's loan. It's not a fee from CHFA. CHFA doesn't dictate or refund or receive it.
Oh, okay, that's interesting. But
yep, private mortgage insurance works the same as if CHFA not being involved. So even if you worked with the lender, CHFA wasn't involved, the PMI would have been structured the same way.
And there
were options of how to structure PMI.
I've got a question from Ron. Yeah, Ron, you're next.
Okay, thanks. Rita.
Yes.
If someone's in the reserves for less than 6 years,
yes,
they don't qualify for a VA loan, but could they do like a CHFA, HFA, and get the 8% off?
Absolutely. Yes,
Okay.
so it doesn't have to be related to a VA loan anyway. And even if they are an eligible service member, it doesn't automatically mean that a VA loan is the best product, right? When they work with a lender, they're going to run all the scenarios. If VA is the best product, that's fine. They still get the discount because the military discount is eligible to be partnered with any first mortgage product for active members, reserve, surviving spouse, veterans. So it's not just for the VA eligibility component.
Okay, and 2 more questions for you.
Okay.
With the FHA 203K,
Yes.
can you still do a mixed use property like you can with just straight FHA 203K?
So there's no difference with the 203K loan guidelines, whether or not CHFA is partnered. The only additional component there is that it's, owner occupied, so they have to agree to occupy it for the life of the loan. But eligible properties or use of the property would be no different. In general, CHFA is going to be for non-income producing properties. So your FHA 203K lender will review those guidelines. If someone has like an accountant and he's got an office there, they have exact guidelines to go by.
Right. Right. Okay. And just did I hear correctly that new construction is only in targeted areas? And if so, why?
For 2 families, yes. Our guidelines are from the state, so ours is not to ask why, right? But we are still not during the construction phase. We are always an end loan. So they're still working with a lender that does construction loans, and we would be the end situation, because our rates are good for 90 days. So, and someone has to have a fully executed purchase and sales in order to do that reservation with us, as opposed to working with a lender, right? You can have property to be determined. You can float a rate till closing. You can lock in before you have a property. Lots of other things. We're in place for the end result when it's ready to go.
But if it's a new construction that's completed, you
Yes.
can
You
buy
have to
it
have
in
a
a
CO.
non-targeted area.
Yes.
Oh, okay. I was confused. And if a question for Liberty Bank, are those programs available for 501c3s?
Yes, I believe they are.
Okay. Thank you.
Well, I don't have any more questions in chat, and I think we've covered a lot of material today for sure. And I want to thank our guests, Jim Hall, Pam, Rita, Ann. All of the information that you guys have brought to the table for us to digest is super. And for all of the agents that were not part of this call today, definitely want to get on to one of these live calls, because you'll have the opportunity to ask questions that you're not able to ask now if you're watching the replay. And Rita's programs where, the CE classes, for the affordable housing will give you a little bit more of a background in terms of being able to, guide your buyers and get them into the right programs. Anything else from anybody?
Thanks so much, guys. Next year, we'll bring you back for some CE.
Excellent. Well, thank you, everybody. And that's
Thank
all.
you.
That's all for our workshop today.
Thank you.
Thank you.
Stay safe.